Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Sonia Shenoy and Pavitra Pare. Good morning, girls. It's a down day so far. Benchmark indices are down close to about 0.6, 0.8% gone on Nifty as well as Sensex. And that's in line with what we're seeing across the rest of the Asian markets. The Korean markets, Japanese markets have lost more than 1%. The key indices, the sectors which are dragging the markets lower today are the FMCG index led by Tata Consumer. The Nifty FMCG index is down close to about 0.9% and Tata Consumer is the top Nifty loser. Apart from that, autos are a bit subdued. The Nifty Auto Index is down 0.8%. Tata Motors is one of the drags today. And you're also seeing cuts coming in on the banking names. Particularly, it's the private sector banks like Kotak Mahindra Bank, which are, it's not a little subdued in trade. But all in all, today is also the December series expiry. So we're going to be watching the moves very carefully in the last 30 minutes. Don't want to say quiet again, right?
And today is the second last day of the year. Right? Yeah. Just look at that. We're heading into a year that was full of ups and downs. So do we have our New Year resolutions ready?
Go ahead.
Well, before New Year resolutions, I'm just glad that, we have first off. We don't have to come to work. It does not happen very often. So
and it's not going to happen for a very long time.
Yeah, so might as well enjoy this first and then we'll get to the resolution.
Can I say something which can bum you out? But we missed out on 25th this time. 25th was not a holiday.
But that's done. We're looking forward.
Look at the glass half full rather than the glass half empty.
Well, why is Reema trying to bring down our cheer?
It's called killing the buzz, right? But I mean, my New Year resolution is not to have any resolutions. That is because every time you plan something, it just doesn't work out. Yeah. So, okay, last 2 days of the year, and I'm sure even the bulls have that resolution that don't have any expectations because this is a market that's perhaps not going anywhere and if anything going downwards. As you said, it's a market that is trending lower. You can see it. There's global cues that are subdued. There's FI selling that continues. There's no real positive trigger for this market in the near term. The only thing is the 50-day moving average of 18,230. That's the resistance on the upside. The market is just fails to cross above that. And there are no conclusive triggers. Let's see from the first part of January. Another thing to watch perhaps is that there's the weekly jobless claims that come out from the US. There is also a couple of more data points that come through that will be tracked very closely. And a lot of big tech stocks in the US are hitting fresh lows. Apple hit a fresh 52-week low. So all of that is going to be tracked. But for now, I think slightly subdued. We still have a long day ahead.
Oh, absolutely. And you have the, monthly expiry as well. So let's see how that plays out. Some volatility, of course, is expected, like we've been seeing the past few days. And since Reema's taken us through what's doing the worst, let me tell you what's doing slightly better is the metals pack. That's, all sectoral indices are in the red, but this one is holding up a lot better. For the week, the metals index is still up 6%. So there's definitely been a lot of action in that space. Some of the pharma names also doing well, but pharma for the week is still trading with cuts of around 1.5%. So that's how the sectors are really looking. In addition to autos on the downside and some of the consumption names that Reema mentioned, you also have real estate, which is coming up with some big cuts once again after yesterday. So that's what's going on with the market action. We're going to come back to this. But first up, let me run you through what we have lined up for you on the show today. Stocks edged lower on expiry day after a week open in line with global cues. Mid-caps fare worse than large cap pairs today. All sectors trade in the red. We'll discuss the way forward for the market with Nilesh Shetty of Quantum Advisors.
And long queues and chaos at India's busiest airport this December raised serious concerns over the shortage of security staff and infrastructure and highlighted the need to ramp up airport facilities. Can the private security industry help address these gaps? We'll discuss this issue with the management of SIS in just a bit.
KFin Technologies made a tepid debut on the bourses today, listing at a marginal premium to its issue price. We will be joined by the management of the company to discuss more on their outlook. All of this and lots more is planned for you over the next 60 minutes.
Well, it's the year and everyone is traveling in the last few days, and that has resulted in a lot of chaos at the metro city airports. Particularly what was flagged off was Delhi International Airport. There were sights of long queues, delays, so much chaos ahead of the Christmas season. The question is this now an opportunity for the private sector players to start deploying security personnel at the airports? To discuss this, we're now joined by the management of SIS. This is a security services company. They're so far not present in the airport space, but is this an opportunity for them? Rituraj Sinha of SIS is now with us on the show. Morning, Reema here, and thanks so much for joining in. Could you tell us, your thoughts on deploying SIS's security staff at private airports? Have you had conversations with any of the state governments or the minister?
Hi, Rima. It's good to be here. Good morning to all of you. I think private security globally plays a very important role in the aviation security space. As you are aware, SIS has operations in Australia. And if you look at the Australian airports like Melbourne, like Perth, there are several airports where SIS subsidiary company is the security provider. In fact, in markets like Australia, there is no equivalent of CISF. So private security effectively takes on that role. In India, in 2016, the draft aviation policy changes came about, which for the first time discussed the possibility of bringing in private security in what they call non-core aviation duties. In the last year odd, we have seen some of those roles being taken up at the private airports gradually. But I reckon this is going to be a massive opportunity. India had roughly 75 odd operational airports a few years back. Today, we are almost operating over 100 airports, and there's another 20 to 25 regional airports that will be operational. Keeping in view the massive and exponential growth in aviation traffic and the high cost of CISF, I think private services definitely will have a massive opportunity.
Oh, absolutely. And given that the chaos is only increasing by the day, I'm sure there are a lot of opportunities for businesses like yours as well. So can you help us with some numbers? What do you think the year to come will look like, Mr. Sinha? In terms of growth, what are you looking at? Because you've already secured double-digit growth in the quarter gone by. What is the prognosis now?
Well, I think this is going to be a good year for SIS. If I take you, just back a few years, during the first year of COVID, also FY21, SIS grew 7%. In second year of COVID, FY22, we did about 10%. And post-COVID, FY23, we are certainly looking at a reasonably good double-digit growth. So we've had fairly good growth. And if I talk to you in terms of numbers, in Q3, you will see us pushing very close to 1,000 crores per month revenue. Very, very close to that, including our cash logistics services. So I think growth is not a problem in India security or in facility management. I think our margins were tepid in the first 6 months of the year, which was a cause for concern for the markets. But as volumes are coming back, you will see a substantial uptick in the margin profile, hopefully in Q3.
All right, got that. Good morning, Mr. Sinha. Thanks for joining us. This is Pavitra. You were mentioning how a lot of the international airports are very different, but it's unrealistic, right, to expect that India is going to get there anytime in the near future. It might take some time. Do you have any kind of assessment of what kind of timeline you're talking about for, even for you to be given these kind of projects? It's not something that's going to happen overnight.
Well, in India, nothing really happens overnight. So I'm not going to bet on that. But I think effectively what we're saying is that we've been in conversation with the Ministry of Aviation and the Airport Authority of India, also the private airport operators. I think the requirement or the need for bringing in private security into airports is evident, and it's completely acknowledged by all stakeholders. We have seen induction of private security in the non-core roles like checking of boarding passes, etc., or queue management already. I think over a period of time, as more and more regional airports come into play, and we have to decongest the large metro airports, which have a footfall of more than 1 million to 5 million per annum, I think private security will get inducted. But yes, you're right, it will not happen over a month.
So, but these conversations that you said that you have been having with the ministry, have they provided any kind of time frame as to when they would want you to come in and handle part of the operations?
Well, this is a fairly complex subject because, as you understand, there is not just the aviation ministry that's involved. There's also the Ministry of Home Affairs. There's a Bureau of Civil Aviation Standards. there are multiple stakeholders, and then there's the private airport owners. So, there are security issues, there are cost implications. It is a little cumbersome, but I think what I can tell you is that I see that all stakeholders are in alignment that CISF needs to be supplemented with private security as early as possible.
Is this a 3-year or a 5-year kind of opportunity?
Hopefully sooner.
Hopefully sooner.
Okay. So if there is, there's another waiting period of around maybe 2 to even 3 years, tell us in the very near term, what are the triggers that you're looking at for growth? What are the opportunities for you?
Well, I think, the biggest thing, the moat for SIS, which has helped us through this COVID period, is that we have a very diversified client base. Private security, facility management type services are used by everyone, whether it's your TV studio or whether it's a factory or a mall or a 5-star hotel or any kind of premises, commercial or otherwise industrial, they use our services. Because of which, our revenue predictability is fairly, clear and evident for the last 5 years that we've been listed. And I think the big triggers for us we've seen this year have been in the uptick, particularly in the industrial space, in the manufacturing space. There's been substantial boost post the PLI scheme. I also see that, a lot of public utilities have helped the government spending on things like metros, etc. They all use private security, electronic security cameras and cleaning staff from us. So public utilities...
Any orders, have you seen any orders fructify there, whether it's in manufacturing, industrial, or even utilities? Yeah. Can you tell us a little bit about the opportunity?
Well, without getting into specific clients, I think we've seen uptick in the metal sector. There's been a lot of, we've secured large contracts from Hindalco, from Tata's in the recent weeks. We've also seen very substantial uptick in the car manufacturing space. We picked up contracts there. So across the whole, even in the mining and cement space, we've picked up contracts. So industrials have been very solid for us throughout the year. And like I said, metro stations, we picked up very substantial contracts in Bangalore Metro, in Cochin Metro, Lucknow Metro. There's so many other spaces that we've picked up. So I think generally, commercial real estate and IT have also come back strongly after a long period of, literally work from home. They have started to get their offices back up and operational, which has been a great boost. Healthcare has been going strong throughout. So if you look at all these sectors, I think they have come through strongly, and that's the reason why SIS is going to report almost close to mid-teens or that kind of revenue growth this year, despite zero acquisitions.
Rituraj, we'll leave it at that. Thank you very much for joining in. A very happy new year to you, your family and everyone at SIS. So there's the management that this is a very large opportunity providing security personnel at private airports, but this is not going to play out perhaps in the near term. But this is a 2-year, 3-year, 5-year opportunity, and SIS is well placed. Just in the near term, they have seen an uptick in orders, particularly from the manufacturing and industrial space. They said Q3 monthly revenue run rate will be very close to 1,000 crore. There is an uptick in margins as well. And for the full year, he kind of indicated mid-teens kind of revenue growth. We'll slip into a very short break on that note. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins us next.
Hey guys, welcome back. You're still tuned into Trading Hour. We have been talking about the equity markets, which are quite quiet. It is a down day, but on very, very thin volumes trading across the world. But let's see what's going on in the world of commodities. Manisha joins us, and today she's going to tell us about what's going on with cotton. Hi, Manisha.
Well, thank you for that. It's a big industry, especially in India, when it comes to textiles. And we have seen cotton prices continue to be very, very volatile to an extent that at one point in time, we did see textile companies shut down their capacity by 50 to even 70% on the lower side there. But take a look at the prices on what we've done in this year, and we are closing 25% on a weaker side. And from its highs, the cotton prices have declined by nearly 45%. Well, blame it on the weak demand that we've seen coming from India, China, and Pakistan as well. India and Pakistan export a lot of cotton and textiles as well, and those numbers also have seen a bit of a decline coming in. The USDA report also suggests that the global cotton consumption is the second lowest that you've seen in a decade now, and the overall global trade also is down by nearly 1 million barrels there. 1 million bales rather. The international cotton prices then, and if you look at the volatility there, we've seen a high of 156, a low of 71, and the current price is trading at 83. So not too far away from the lows of this year. For the Indian markets as well, we saw an all-time high of 1.10 lakh rupees per candy. From those kind of levels, we've come down to 60,000 rupees. So quite a bit of a decline coming in there as well. Even at these cuts, we are looking at the Indian cotton prices trading at a premium to the international prices by nearly 10 to 15%. A couple of pain points that India really seems to be feeling in sense of cotton is one, the productivity, where our productivity is 468 kgs per hectare versus the average world productivity at 74 kgs per hectare. Also, India does not produce so much of long staple cotton. Our production is 5 lakh, our consumption is 20 lakh bales. So the import in the Indian markets are quite strong, and these are some of the pain points that Indian industry as of now seems to be putting forth.
Okay, Manisha, thanks a lot for that. Well, let's do one thing. Let's get our view back on the market. It's still down about 100 odd points, the Nifty that is, but hasn't broken 18,000 just yet. So quiet, but quiet on the downside. Let's slip into a quick break. When we return, we'll have Mitesh Thakkar of earningwaves.com to talk about the markets. He'll also discuss his top trading bets. Stay tuned. Welcome back to Trading Hour. As promised, Mitesh Thakkar of earningwaves.com joins in for a quick technical check of the market. Mitesh, how are you feeling about the rest of the day? The good part is that the sell-off has not accelerated further. It's restricted to about a 100-point cut on the index. Are you still cautious, and what are the stocks you're looking at?
Good morning again. I think I'm still cautious. I'm still worried about the fact that we'll eventually retest the lows which we made earlier. The only thing is that we haven't got conclusive signal of this pullback ending. So not going short on the index, but trying to find some shorting opportunities on the stock side. Though right now I have one buy and one sell call. JSW Steel, that's a buy. I recommend buying here with a stop below levels of 750 for targets of 785. And HDFC Life is on the selling side. That's a sell with a stop at about levels of 567 for targets of 544.
Mitesh, thank you very much for that. As we wrap up the year, the Indian economy has also seen multiple challenges in 2022, ranging from a spike in energy prices from the Russia-Ukraine war to dealing with the fallout of the Fed rate hike trajectory. Sapna is here to take us through the decisions taken by the government to deal with these challenges and also telling us what lies ahead in 2023. Sapna?
The initial impact from Russia's invasion of Ukraine saw Brent crude prices shooting to $130 per barrel, global food supply being disrupted, and inflation soaring. This posed multi-pronged challenges to the Indian economy. With April inflation shocking at 7.79%, the government swung into action. Adding to the freeze on pass-through of crude oil prices to petrol diesel, it restricted wheat exports in May and followed it up with a slew of other measures, including slashing excise on petrol and diesel and doubling the fertilizer subsidy. But as crude prices continued to rise, more was needed. India shrugged off intense global pressure and leaned heavily towards Russia for cheaper crude. So much so that Russia is now the top supplier of crude oil to India, upstaging traditional suppliers like Iraq and Saudi. But the government also cashed in on an opportunity these surging prices threw up. It introduced a windfall tax on oil cos and mandated them to ensure that domestic sales of petrol, diesel and ATF were at least 50% of their exports. Multiple reviews later, the tax remains, even though Indian basket of crude oil has slipped to below $78 per barrel. This is very close to the two-week average of $75 per barrel, below which threshold the windfall tax should become nil. Indications are the government hopes to garner close to 40,000 crores from this windfall tax by March end. But if the drop in crude oil prices sustain, that number may not hold. In the meanwhile, spike in global inflation prompted the American central bank to hike rates aggressively. And this pushed the rupee to record weak levels, from breaching 79 to a dollar on the 5th of July to 83.20 to a dollar on 20th October. RBI's measures to shore up the currency, which included more diversified sources of forex funding and internationalization of the rupee, have had a limited impact so far. The trade deficit continues to widen, crossing $198 billion in the April to November period. Meanwhile, between April and September, India's forex reserves dropped by $75 billion to $432 billion. Since then, RBI has managed to claw back reserves to around $564 billion, providing 9 months of import cover. It was also managed to make some headway on inflation. November CPI has fallen to 5.8%, which is within RBI's tolerance band. However, the rate hikes are taking a toll on the GDP. RBI has now revised the FY23 GDP forecast down from the 8 to 8.5% in the economic survey to 6.8% currently. That notwithstanding, India's economy expanded by 9.7% in the first half, thus continuing to be among the fastest growing in the world. The government has also stuck to fiscal consolidation and not resorted to additional market borrowings, which is a big plus. So, as we move into 2023, the challenges are plain. There's uncertainty over COVID infections, given what's happening in China and elsewhere. There's pressure to maintain growth with fiscal consolidation, even as large parts of the world stare at an impending recession. And of course, keeping inflation within comfort levels while revisiting fuel prices and maintaining a stable currency.
Thank you very much for that. Get into a short break. Up next, we'll discuss market fundamentals. Nilesh Shetty of Quantum Advisors is with us next. Welcome back. As we head towards the end of 2022, what can we expect from global equities? Nimesh is here. He's at the big wall, and he's got us a wrap of what the brokerages make of the year to come.
First look at the global data and what the global themes looks like. As far as the big themes are concerned, there are the four big themes that globally one has to look out for: the recession theme, the inflation theme, Fed pivot, and the China reopening. These are going to be the big four themes as far as globals are concerned. Some big reports have come out from influential brokerages. So what is Credit Suisse saying? Credit Suisse is saying that 2023 is going to be tale of two halves. The first half, the focus is going to be on higher rates for longer theme, which means that the equity performance will be muted. But in the second half, as central banks pivot, they are expecting investors to rotate to high interest sensitive sectors with a growth tail. So that's the view from Credit Suisse. Look at what Fidelity has to say. Fidelity believes that cyclical recession is the most likely outcome in 2023, which means that they remain cautious on the global equities. However, they are very bullish on ASEAN and Indian markets. So that's a big bullish view from Fidelity on India. I've put out some number as well. Morgan Stanley has put out the numbers for 2023. They have an S&P target of 3,900. They have a DYX of 104, and they've put out a Brent target of 110. That's the number which Morgan Stanley has put out for 23. But what this all means for the Indian markets. Now, for India markets, I've put out four big themes. The first big theme is the big India outperformance. 22 was a big year of India outperformance, so we need to see whether that can continue. We are sitting on very peak valuations, and the sentiment is quite bullish as well at the retail end. So that could be a bit of a negative for India. The waning commodity inflation, that's the only positive thing which can play out for India in 23. And the retail flows, which have been a big backbone for India, that is something to track in 23 as well. What are the brokerages saying? So, Goldman Sachs has put out a target of 20,500 for end of December 23, but they believe that India is unlikely to outperform for third year in a row as China and other cyclical markets like North America opens up, and they may do better. So that's the view from Goldman Sachs. They are, in terms of sectors, they're overweight on sectors like banks, insurance, industrial, cement, and utilities, whereas they're underweight on names like IT, NBFCs, consumer durables, and retail sector. So that's the Goldman Sachs view. Look at Morgan Stanley. They believe that they have a target of Sensex target of 68,500. But even they believe that India's relative gain may take a breather in 2020. So that's summing up as a big theme for India as well. In terms of their sector overweights, they're overweight on financials, technology, consumer discretionary, but they're underweight on most of the other sectors. In fact, we have. But even I was looking at the Buffer Securities note, and they have a target of 19,500, and what pointed out, it could be a very volatile market for us with a range between 17,000 to 20,000. And within sectors, they're overweight on financials, industrials, staples and utilities, whereas they're underweight on IT, discretionary, autos, telecom and pharma. So the big theme is India can see a bit of a breather in the first half of 2023.
Nimesh, thanks a lot for that. Very interesting. So thank you for recapping what all of these different brokerages have to say in terms of what 2023 could look like. In fact, we also have a guest joining us right now. Nilesh Shetty, Portfolio Manager at Quantum Advisors, joins us on the show now to discuss the market. Nilesh, good morning and thank you very much for joining us. This is Pavitra. What do you make of what 2023 could look like? Yes, we have seen outperformance in the year gone by. What do you expect in terms of, where the market is headed over the next year?
Yeah, just the way India is positioned domestically and internationally, it's unlikely that India would have underperformance or significant underperformance relative to EMs or rest of the world. I know a lot of large investors who had significant allocation in China in EMs are very clear they will not allocate more to China given the political developments there. The only other emerging market which sort of comes in their mind to sort of put more money into right now is India. So I expect India to draw a lot more flows. So again, the way India is positioned globally relative to the rest of the EMs, which are going through some of their own problems, makes a very strong case for more flows coming into India internationally. And the second is just the way the economy is positioned domestically. I mean, after almost 7 years of economic slowdown from 2013 to 2020, it looks like we hit a bottom somewhere around that COVID period, and the upcycle has started, and it will last for the next 3-4 years for sure. And in an economic upcycle where corporate earnings are rising and flows remain strong, domestic as well as international, I would be very surprised if Indian markets do not give decent returns.
Okay, so decent returns expected from Indian markets. Nilesh, good morning. There are a lot of new sectors which are emerging, right? Whether it is electric vehicles, renewable energy, defense, which has played out quite well actually in 2022. Where do you see the alpha in 2023 emerge from?
Yeah, so the way we have positioned our portfolio, we have a very large weight in financials, including banks, which have, if you plot the market from the bottom of COVID, it has actually been a big underperformer, the entire financial space. And so we think there is value there. We have a very large weight in two-wheelers because, again, most of these companies are 3-4% dividend yield, generate a large amount of cash. There has been periods of rural distress which has hurt their valuations, but given where they stand today, any kind of rural pickup will see a re-rating in these stocks. We have incrementally started adding weights in sectors which were the fancy of the market, say 2 years ago, but have been sold off because they are near-term challenges. So you have companies in the insurance space, in the broking space, in the asset management space, which were again trading at substantially high valuations, but now they've seen a significant de-rating as some of these sectors are going through their own internal challenges of competition and near-term growth challenges. So we think this is where opportunity lies. Investors perhaps might want to look at the sector. Also, incrementally, we've been adding weight in IT as well after the sharp correction. We think the long-term story is still intact. You might have some near-term challenges on cutting discretionary spends by global IT companies or global spends on IT. But apart from that, just where the valuations are, they make a lot more sense to allocate this sector now relative to where they were a year ago.
Just one follow-up, you said you're overweight on two-wheelers, but there seems to be very low conviction in terms of recovery in two-wheelers. There are new emission norms as well. Rural market has not recovered in a big way. So are you overweight only because valuations look comforting for you, or are you expecting a revival in demand?
Yeah, both. So valuations have been attractive for a while now, last almost 3-4 years. So volumes peaked out somewhere in 2019, just before the emission norm changed. After that, we've had periods of COVID and rural distress, which has kept volumes very low. And of course, price hike has been substantial post the change in emission norms, which has taken a bit of while for the demand to catch up. But again, given the quality of companies in that space, very clean balance sheets, very large cash flow generation, and the relative position that they enjoy within the space that they occupy. So a large player in the executive segment and the other players slightly in the premium segment. Again, we think there is a structural story still there to play out, given the poor state of public transport. The de facto public transport for India is two-wheelers. And as sort of more job creation happens in tier 2, tier 3 towns, more number of people come into the job market, their first choice of preference to buy would be a two-wheeler. We still think volume growth will recover from where they are today.
You said that you've started buying into IT names. If you have to invest an overall amount of 100 rupees, how much have you bought at current levels? And just to get a sense of how much is still left for you to go ahead and buy? Because you are waiting better entry points.
So our weight in the IT sector probably has gone up by 3 percentage points. So we had reduced the weight by almost 4-5 percentage points at the start of the year, given where valuations are. After the correction, we've started adding an increase of weight by almost 2-3 percentage points, but we'll continue to add. Again, we do not believe the long-term structural story has been hurt. I mean, Indian IT companies still have a very, very small share of the global IT outsourcing market. And that share is only going to increase. You have these near-term cyclical challenges where if the Western world goes into recession, you might see some cut in discretionary spends. So growth rates which were in the range of 12 to 15% drop down to say 8 to 12%. But it's still a very attractive growth rate for the kind of cash flow that they generate. And of course, once the cycle reverses, you again see an upcycle in growth rates. So at a certain valuation, it makes a lot more sense to us to add to them. And right now, we think it's relatively attractive in terms of where they are positioned in valuations.
Okay, got it. That is on IT. Nilesh, how do you look at the entire auto pack? And, is there any theme within that you would play, whether it's the EVs or is there any sort of segment within the autos that you would look at? Because we are still talking about demand not quite, picking up too much. We have the December sales also on the 1st. So how would you look at this space?
Yeah, I mean, Indian auto story is one of the simple sort of top-down allocations that any investor can make. I mean, where penetrations are in the four-wheeler as well as sort of commercial vehicles or two-wheeler, there is a long headway for them to grow. The question is valuations. For us, there is a lot more valuation comfort on the two-wheeler side than the four-wheeler side. The companies on the four-wheeler side remain, a lot of the good news is already factored in their valuations that they've not corrected materially, unlike the two-wheeler space. So we have had allocation in the two-wheeler space. But again, outlook for the auto sector remains very, very attractive. We are not big believers of the EV space so far. I mean, there is a long-term sort of transition which is going to happen, and a lot of new names have come in. But when we go and meet a lot of these new players, the ecosystem is just not there. A lot of them still remain assembly shops which are importing from China and selling in India. We still think the incumbents will perhaps become a larger share of that EV market whenever it develops. But I still next few years still will be the old ICE engines market which will dominate. And most of the existing players which have very strong position there, it will be difficult to dislodge them.
So what about, these auto ancillary makers who are going big in the EV space, whether it's something like an Uno Minda, or even, in the OEM space, something like a Greaves Cotton. They've given great returns to shareholders in the past. What do you do with these names?
Yeah, we've actually had a very small allocation in the auto ancillary space. So there are themes which investors like to buy, but when you go on the ground and see the actual size of the market and what is the quantity of the volume that these people are doing is still so negligible compared to the size of the market. So what I think is the news flow share compared to the market share of these EVs, there is a big gap. So they dominate the news flow for some reason, but on the ground activity is still very small. Again, a lot of investors looking at news flows buy into companies, but on the ground data suggests otherwise. And you need to be careful if you're trying to buy into these companies, betting on these long-term themes.
Nilesh, thank you very much for joining in and wish you a very happy new year. Get into a short break. On the other side, we'll talk about the new kid on the block. KFin Technologies has made its debut in the Lal Street. We'll be joined by the management in just a moment. KFin Technology has made a bit of a lackluster debut on the exchanges. The stock has slipped after opening at a slight premium to its issue price of 366 rupees. As we speak, the stock is marginally down, close to about 1%. Shrikant Nadella, the whole-time director and chief executive officer of the company, is now with us. Shrikant, morning. I remember a conversation that we had when you had come to our studio when the IPO was open for subscription. But now that you're listed, you can give your investors, the people who've invested into your company, some guidance. Could you give us a sense of what FY23 growth is going to look like for your company?
Very good morning, and thanks a lot for having me over. More than anything else, I think the listing today marks probably the journey that we've traversed, over long years, and we are truly elated. We just had a great listing moment here. And the stock performance, if not anything else, also reflects the quality of investors we have had onboarded. long-only quality investors who are seeking qualitative returns from us. Now, as far as the business sentiment is concerned, as I said, and I continue to remain extremely bullish on the financialization story of our country. And, K-Fintech, obviously, given it's on almost every asset class that the country deals with, whether it's equity or mutual funds and alternatives, so on and so forth, we believe that we'll be able to trail, the growth journey. And, of course, at the same time, given our market share expansion, over the last, 3 years and more specifically in the last 6 months, puts us in a good stead in terms of growth projection for FY23.
So what are your growth projections in FY23? I mean, have you added any new clients so far this year? And if yes, what is the expectation even for next year in terms of client addition?
Sure. See, given the broad breadth of our business, we add literally 2 to 3 clients every single day, right? In different lines of businesses. In the case of unlisted or listed, in the case of registry, alternate investment funds, we've added about 15 in the just a fortnight that had gone by, and we recently added a client in Southeast Asia as well, and that's an ever expanding bucket, of course, right? And the mutual funds, given it is still the largest one, I think some of the decisions around the mandates are yet to be taken by our clientele, but our journey in terms of client acquisition continues to be in a pretty robust pace.
All right. Hi, Shrikant. Good morning. This is Pavitra. On your revenue itself, can you tell us what we should expect in the second half? Because the first half of this year, you have clocked in around 350 crores, which is one of the better performances in the past few years. So do you think this is something that will continue into the second half? And also last time when we spoke, you did talk about increasing your international contribution from around 13% to 20%. Can you tell us what is the kind of investment you will need to do that?
Thank you, Pavitra. Absolutely spot on. So 350 crores is the top line we've clocked in H1. And this should be read in the backdrop of significant headwinds, right, which is effectively the mark-to-market of Nifty was down almost 10% in Q1, slightly up in Q2, but net from 31st March to 30th September, it was still negative. We also had a ban on new fund offerings in the case of mutual funds for almost 3 to 4 months. So in the backdrop of those headwinds, K-Fintech clocked about 19.6% top-line growth. We hope to continue to maintain the trend. And in terms of our international operations, our presence is largely in 4 countries at this point in time. That's Malaysia and Hong Kong, Philippines, and soon to start Singapore. And also we have a client we have signed up in Canada in the previous month. So this puts us in a very strong, footing in terms of our offerings, not just on the transfer agency side, but also on the fund accounting administration side. So investments-wise, we are an asset-light company, as you are aware. People are our assets and the systems and the platforms that we build. So we do not look at capital investment. Whatever we build as platforms usually gets written off to the P&L.
Okay. I remember the last time we chatted, you indicated that your market share in the number of asset managers is high at 59%. But your market share as a percentage of the equity AUM is lower compared to your peer, and it currently stands at 30-35% thereabout, which basically means that you have on board some of the smaller mutual funds which do not have a very large AUM. What steps are you taking to increase your AUM market share from the current levels?
Thank you. See, the assets under management is a factor of how quickly our clients grow. And you need time gestation for that to happen. There are certain asset management companies which have been there since the very beginning of 1960s, 1970s, in the advent of the mutual fund companies. And the bank-based mutual fund companies obviously had the added advantage of massive distribution, chains in the form of brick and mortar setups that have helped many of the asset management companies to grow rather rapidly. K-Fintech, yes, has a higher market share in terms of the number of asset managers. The growth of my asset management companies is effectively directly reflection on how fast K-Fintech could grow. If you see the trend over the last 24 months, our market share in the overall AUM, especially on the equity AUM, has moved from 29%. Today it stands a little over 35%. Now that's a significant market share increase, especially during the years when the overall mutual fund industry itself has grown. There are definitive steps that we take. We are, let's face it, we are enablers for the fund houses. And, we create differentiated solutions and products and platforms which help my clients to grow faster, leveraging technology and through superior interaction and integration with the intermediary channels. That's as far as how much KFintech can go to help our clients grow. But truly, it is time will be the biggest player in this case, as many of the asset management companies have been growing at a very rapid pace, which KFintech supports today.
All right, we will leave it at that. Thanks a lot for joining in. Let's slip into a short break. On the other side, we'll get you more on the markets. Do stay tuned in.
Welcome back. Markets are still down close to about 80 odd points. On the Sensex, we are lower by 250 points. But as you can see, there has been an uptick of just about a couple of points. And considering how quiet the morning has been, we're going to take that. It's State Bank of India and Infosys which has moved up and perhaps is contributing to that fractional uptick that we are currently seeing. SBI now up 0.5%. Infosys is now back in the green. But as we wrap up on Trading Hour, we're going to leave you with the address made to the employees by Reliance Industries Chairman Mukesh Ambani. He's laid out his expectations from each of the conglomerates' businesses. He wants Jio to now provide unique solutions to the world, Reliance Retail to deliver significant benefits to all stakeholders, integration of media and entertainment with digital to reinvent the industry, and new energy business to transform the world. Here's an excerpt, and thank you for watching this show.
The end of 2022 is when Reliance will have crossed the halfway mark of its golden decade. In 5 years from now, Reliance will complete its 50 years. All of us are proud of what we have achieved so far, but the journey ahead is going to be far more exciting, more rewarding, but also more challenging. Let me spell out my expectations from the leaders and employees in all our businesses and initiatives. First, under Akash's chairmanship, Jio is rolling out the world's best 5G network across India at a pace which is faster than anywhere in the world. Jio's 5G deployment will be complete in 2023. I heartily congratulate the entire Jio team for further consolidating the #1 position in the digital connectivity business. But Jio platforms should now get ready for India's next big opportunity to provide unique digital products and solutions to both domestic and international markets. Since every single village will have 5G connectivity, India has a historic opportunity to completely erase the rural-urban divide which has plagued our country for so long. We can now ensure that no Indian will be deprived of access to high-quality education, high-quality healthcare, and high-productivity economic activities. This is how Jio can accelerate India's inclusive development. Second, under Isha, our retail business has grown rapidly. It has emerged as one with the widest and deepest reach in India across all product baskets. Most significantly, Reliance Retail has created over 2 lakh new jobs last year, becoming one of India's leading employers. I congratulate the retail team for setting new standards in disciplined execution, which is the key to its success. But I know that all of you in the retail team are capable of chasing even more ambitious targets and goals. Like Jio, the growth of our retail business will also have a cascading effect on India's inclusive development. Our young people will have more jobs, our farmers will have higher incomes, our SMEs and large manufacturers will become more productive, and our trader partners will become more prosperous. Third, we continue to build on our leadership in the O2C business with new capacities and capability. In the upstream exploration and production segment, our team continues to work harder for providing energy security for India. All of us are excited about the media and entertainment business and its integration with digital services that will reinvent the entertainment industry completely. My congratulations to all of you in these enterprises. Keep doing your good work, and I am sure you will scale higher summits of success. We are particularly proud of our JWC team that hosted the G20 in Mumbai, and of course, our life sciences team that is going on and charting new paths of innovation. Fourth, new energy is Reliance's newest startup business with the potential to transform not just the company or the country, but the entire world. It shows that we care for the planet, we care for all the people on the planet. With Anant joining this upcoming next generation business, we are making rapid progress in getting our gigafactories in Jamnagar ready. From being India's largest and most valuable corporate, Reliance is now well on its way to also become India's greenest corporate. The goals before our new energy team are crystal clear. Enable India to achieve security and self-sufficiency in energy by reducing dependence on imports. And remember, you can do so only by remaining agile and ahead of the technology curve. Fifth, 2023 will also be a year of renewal and revitalization for Reliance Foundation. Under Neeta's inspiring leadership, Reliance Foundation is working on even more ambitious new initiatives in education, healthcare, sports, women's empowerment, and ecological and environmental conservation.